Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The biggest disappointment in my mind was really the gross margins on the core auto business. 80% of the call was discussed. Elon was discussing things that really don't exist at this point. But if you just really get back to the nuts and bolts of the company, the auto business is really struggling. So I think the pullback is warranted. We're going to be in an information vacuum until October 10th. We have that autonomy day, and then we get more details about the new low-cost vehicle that's certainly needed in this type of economic environment.
The CapEx spend, to me, is protecting the moat. And they are seeing improved engagement and customer satisfaction in search due to AI inputs. So I think one of the things that we have to remember is that in the short term, the hedge funds and the algorithms, they love to sell off on whatever the particular topic of the day is. But usually that volatility is a friend to the long-term investor.
AI is sucking all of the oxygen out of the room. So it's not just one company, but now I think we are entering that dangerous part of the story where we need to see it in the numbers.
We have got 1 hour to go until the market close, and it has been quite a day in the markets, Josh. We've got the Dow down about 418 points right now at about 1%, but then look at the acute selling that we've got going on in the S&P 500 down 2%, set for its worst day, at least this year. The Nasdaq Composite selling off the most since late 2022 with this 3.4% decline, and it all has to do with some of these earnings reports that we've started to get from the Magnificent Seven. By the way, the market value wiped off of the Magnificent Seven today looks like it's the worst since Meta went public, according to data from Dow Jones. So definitely seeing a lot of deep, dark red on the heat map today.
Yeah, I think investors have kind of told themselves a story, Julie, and it was a very positive story. It was, economy's decent, earnings decent, Jay Powell was ready to cut, and then here come Alphabet and Tesla, and they kind of take you for a spin here. They underwhelm. A couple things that points out. One is, this rally, as we've talked a lot about, has been narrow, and you were kind of counting on mega cap tech. I think also was an interesting note from Peter Bukvar, the market strategist. He was telling his clients today, he was kind of reviewing these big tech earnings, and also Peter was kind of wondering, does it tell you something broader about the AI trend and how important that was obviously to this rally? And are there folks now looking over these earnings prints, they're listening to the calls, and how many investors, Peter's wondering, have decided, maybe all this AI spend is more of an expense right now than an actual revenue generator.
Yeah, that's a great point. So let's bring up those two that you mentioned, because we have Tesla, which, to the point of the AI, there are certainly a lot of investors in Tesla who are investing in it for what they think is the long-term future of AI, of robo-taxis, of some of the long-term endeavors.
Which is what the company wanted to talk about.
Right.
Robo-taxis,
but right
energy.
Now, they're seeing waning demand for their vehicles.
The car business,
and it looks like they're going to sell fewer vehicles this year, perhaps, deliveries than they did last year. So that's what's sending the stock down so much. So to your point about it not sort of coming home to roost. Now, in the case of Alphabet as well, down 5%, even though a lot of the metrics looked good. We have been talking to people, at least this year, people like Brent Thill, who have said this is not the full year of AI realization and monetization. That's going to be next year and beyond. But people who are piling into this aren't necessarily looking at it with that time frame. And maybe that time frame is even going to get pushed out. So it's not necessarily that AI is not going to be realized. It's the timing and the sort of reconnoitering now that people have to do based on these numbers that we're getting now, where the AI is not necessarily yet baked into as broad a swath of the business as people would hope.
Yeah, even as the companies tell you, spend. Right?
Exactly.
Stocks sinking here today after lackluster earnings reports has raised some concerns that maybe the big dogs in the Magnificent Seven have lost their bark when it comes to fueling gains in the markets. For more on the latest sell-off, let's bring in Scott Kronert, City Head of U.S. Equity Strategy. Scott, it is good to see you. I heard one strategist kind of tell his clients today, Scott, this is what it looks like when earnings underwhelm and the market is priced for perfection, in his words. Is that how you see it, Scott?
We see it with a little bit different spin. What we'd argue is that the underlying growth trajectory fundamentally has not really changed here. What's happened is that the price action over the past several months has taken the implied growth in the valuations to levels that are really, really difficult for these companies to hurdle, right? So essentially it puts an increased burden on beats and raises. And what we've been arguing going into the third quarter is that we have to allow that this stretched setup has to normalize. And so we've gone into the quarter looking for a 5 to 10% drawdown in the S&P. And I think what we're seeing with the quarterly reporting period is underscoring this.
And then, though, Scott, do you use that as an opportunity to add to? I mean, it sounds like you still believe in the growth story, but things got stretched. So does that imply then when things drop that you get in on the growth names that you believe in?
That's correct. I think under the surface, the underlying growth trajectory for many of these companies has not changed. If we've essentially stretched the implied growth or the valuations too high, then you allow what's perceived as a short-term disappointment to set up for a longer-term buying opportunity. And that's how we're thinking about the Mag 7 and the broader mega cap growth construct right now.
Scott, can I also get your take on the AI story, which has been such, investors so excited about that, Scott, and a reason, of course, for the rally in the market. I was just talking to Julie about this. Some strategists, Scott, today, they were looking over the reports and the reaction to Alphabet and to Tesla, and they were wondering maybe investors are rethinking that AI trade, and they're thinking, you know what, all this AI spend, maybe it just means it's much more of an expense right now rather than an actual revenue generator. Just curious to get your thoughts on that, Scott.
Yeah, I think that opens a great discussion, Josh. Essentially, where this is going to go is that we're going to be debating this for the next couple of years. Have we overspent on AI versus its opportunity or not? And we're going to go back and forth. Our view is that you have to distinguish where in the AI circuit different companies play. So right now, our focus is on those companies that are essentially developing or enabling AI technology. Got that? Okay, that's the Mag 7 sort of in a nutshell. Longer term, we're continued quite bullish on S&P 500 fundamentals. And where we think the longer term element of AI is going to come into play is it's going to be, in many cases, almost imperceptible. It's going to be under the surface in productivity improvement, improved profitability, and therefore valuations across a much broader swath of companies. But as a C-suite, you're probably discussing your AI strategy, and you're in early stages of implementing it. You can't expect and shouldn't expect a payoff on that for another year or two. So we're going to have a dual-pronged response in terms of how we're evaluating AI. Are we overinvesting or underinvesting? I think we're in pretty good shape structurally, but we're going to go into this ongoing back and forth of have we gotten too aggressive or not. I think that's going to be part of what investors ought to expect over the next year or two.
Scott, what I also find interesting is that we've had this recent discussion about rotation in stocks and a broadening out of the rally and small caps coming up and some of the other areas catching up. And then on a day when tech is down, it's taken everything down with it. So much for the ballast of the other areas of the market and the broadening. How are you thinking about that, and how's that going to play out during the rest of the earnings season?
Well, we've been advocating the small cap trade of late, and so I'll take the relative performance advantage that we're getting today as part of the way this plays out. But look, we've got several forces at work in the markets right now. You've got the AI underlying growth influence on the broader market, number one. Number two, we've been navigating, where the election debate is taking us in terms of what that might mean for policy in 2025 and beyond. And number three, don't forget, since the end of June, the market in different ways, shapes, and forms has begun to discount something akin to a soft landing. So we got three different forces at work. The small cap play, along with the value play, along with our preferred positioning in areas such as financials via banks, the consumer sector, even real estate, are all predicated on getting to a Fed pivot in the September timeframe and leaving behind this 2-year period of hawkish Fed narrative and transitioning to something that should ultimately benefit those more traditionally early cycle areas of the market, which, oh, by the way, have lagged and have a better valuation setup.
And Scott, when you say you like small caps there, that's because just earnings growth and valuation look attractive, Scott?
So here's the twist. I think we all know the relative valuations off the charts attractive for small cap. That's a head fake. I don't pay too much attention to that because it's a function of how great the mega cap growth cohort and large cap has done. The absolute valuations are also attractive versus history. And what we're focused on is the earnings growth setup. Small cap earnings have been down to flat for the past 2 years. Right now, consensus expectations are for small cap via the Russell 2000 or even the S&P 600 indices to move materially higher next year in the mid-teens. Now, we certainly have to allow that out-year expectations can always be a little bit aggressive. But as we go into next year, function of your base, in function of what should still be a fairly stable economic setup going into 2025, you're going to get a narrowing of the earnings growth disparity between large and small. That should come back and benefit small cap courtesy of a lower valuation starting point.
Scott, assuming that the Fed is going to cut at some point this year, we've talked about the earnings trajectory. We've talked about AI. We have talked a little less about the election here, although you alluded to it. And I'm just curious how you're sort of factoring that in, particularly when you talk about that economic backdrop that you just mentioned.
Yeah, so a complicated discussion, Julie. Yeah. We could spend a lot of time talking about this, but what I would simply say on this is that we've been concerned that either candidate, either party is going to face an issue going to 2025. And that's the burgeoning deficit situation. And whether we begin to lose some of the fiscal stimulus element of the past several years going forward, and does that at some level weigh on our earnings growth conviction? So I think what we're looking at here is, both candidates, both parties, in our view, are mostly equity negative right now. The Trump narrative with talk on tariffs conjures up supply chain dislocations and has us concerned that what comes with a push down across the board tariffs is some muddling on the margin story for many companies. On the other hand, the Democratic side, you're looking to push tax rates, particularly on corporates, if you can, and that's going to be a function of whether you have both houses or not. In both approaches, we're looking at potential pressure points on equity fundamentals. So we have to weigh that into the equation. That's our starting point for how we're evaluating both candidate party policy platforms going forward.
Well, we'll talk again about this, I am quite sure, Scott. Great to see you. Thanks for joining us.
Take care.
As we've been talking about, Tesla shares getting crushed today following a mixed earnings report. Yahoo Finance's Prasubramanian is joining us now with more from the latest report and sort of the big takeaways, if you will, now that we've had some time to mull it over and watch that stock reaction.
Yeah, I heard you guys talking earlier about sort of like high level kind of results there, numbers wise for the company, growth rates, things like that. But a couple of things that sort of stuck out to me was, of course, we talked about robo-taxis and the new reveal date, Musk divulging that 10/10 date during the analyst call there. The big issue, I think, is they claim to be using the unbox production technique, which is a new assembly process that could probably take years to develop. So that means that the robotaxi might not come out for some time if they actually use that unbox process.
What is that?
Basically, it means that instead of kind of a car going down the line, you build parts of it in different areas of a facility, and then you bring it all together in a certain spot. And you can build multiple cars in different areas and bring them together in different spots as opposed to one long line.
But no one has ever done this.
Not really. Basically, what it means is that you can build the cars in a smaller footprint, is sort of what they're saying, and it's cheaper to build that way. We'll see if it actually comes out. So a second thing that I wanted to mention was the affordable EVs, right? So they're talking about first half 2025, they will actually be in production of these affordable EVs. Now, we haven't even seen them yet. When are we going to see these? Let alone
what does affordable mean, Pras?
Like sub $30,000, $25,000 car. When are we going to see these? Are they really going to become in production at that time? And the big concern here is that they need them because their gross margins are getting hit so hard right now. You need to build a cheaper car that can have better margins, and that's one way to do that. So that's sort of the two things that stuck out to me is, are we going to see these two things anytime soon, and then what the effect will be when they come out.
And then after the bell, more numbers. Ford on deck. What do we expect there?
So top line results here, revenue $43.77 billion, and also adjusted EPS of around 67 cents a share. If I can read this properly, my eyes are sort of glazing over these days. But big thing, big high level, beyond the numbers here is what are they going to do about EVs? We've seen them actually just last week convert a possible EV factory in Canada to Super Duty truck production, kind of, again, leaning in on that really profitable commercial truck business that for them that has been so successful recently. Ford Pro is basically projected to make more money than Ford's Blue commercial car division. I'm sorry, consumer gas-powered car division. So that's kind of a big deal. And finally, you know, what's Jim Farley going to say about the future path of stuff like Ford guidance? Are they going to meet what GM did earlier just yesterday when they boosted guidance for the second time this year? Ford said earlier this quarter that they would meet the higher end of their current guidance. Are they going to improve on that? That's a big question, I think.
Yeah, yesterday Barron's Al Root was on Goodbye or Goodbye. He said, avoid Tesla, buy Ford. Half of what he said was right. We'll find out about the other half after the close. Thanks a lot, Pross. Appreciate it. We're just getting started here on Market Domination. Coming up, shares of Alphabet taking a hit today despite beating on second quarter estimates. So what's got investors concerned for the tech giant? Plus another big earnings day on tap. After the bell, we'll break down the latest numbers from Ford, Chipotle, and IBM. And at 4:45, the chairman and CEO of Whirlpool, Mark Bitzer, will join the program to dive into the company's latest earnings report. Stay tuned, all that and more when Market Domination returns.
The tech-heavy Nasdaq leading the declines on Wall Street, led by sharp declines from Tesla and Alphabet, thanks to disappointing earnings. Tech editor Dan Howley is here with a closer look at why Alphabet shares are sliding. Why, Dan?
It's interesting, right? I think some folks are disappointed that they didn't kind of beat more, even though they did beat on the top and bottom line. There's the issue with YouTube ads. That was disappointing, although Google's main search ads didn't disappoint. They were rather good. And so it seems to be a mixed picture. I think there's also uncertainty still from some analysts as to when they're going to see that AI investment really pick up. And Sundar Pichai kind of danced around an answer to that, basically saying, look, we're rolling this into all of the products. It is important. It's going to improve us down the line. So nothing really solid over there. And then obviously the increase in spending that they saw for AI. I think it went from 1.1 billion to, I think they put it under Alphabet's activities to 2.2 billion. And so, there's issues there that I think some investors are kind of nervous about. But, when it comes to these kinds of technologies, if they do pay off, it does take more than just, a few quarters, a year or so, right? So they're rolling this out. Don't forget, they only just started putting out their AI overview. That's their search offering in, I believe, April or maybe June, around there. So it's not May. So it's not exactly something that's been around for a while. But I think, obviously the big deal is going to be, how's that impacting ads? Do we see more ads? They're starting to sell ads around that. And then on the enterprise side, what does that mean for cloud? And cloud did well. It had a $1 billion operating profit income this time around, right? And that's the first time it cracked that. So, it's interesting to see this reaction.
Yes, most definitely interesting to see the reaction. We're also waiting, speaking of big tech and big AI, we're waiting for IBM results after the close of trading. What are you sort of zooming in on there?
Yeah, I think obviously the answer is kind of similar to Google, but not exactly. They do have their cloud business. They've been building that up. They're also, they've been in AI for quite a while. The Watson AI was on Jeopardy before anybody was like, yeah, AI on my phone, cool, right? So they've been doing this for quite some time. I think the consulting business that they're doing is also doing very well for them. So where they're adding on there is going to be something that a lot of people are going to be watching. But, I think when it comes to tech at this point, if you're not talking about AI, then you might as well not be talking at all. And so we'll see what IBM has to say as far as that goes after the bell.
Looking forward to it. Thanks, Dan. Well, the Magnificent Seven may need to be renamed the Miserable Seven, at least for today, as investors get their first look at second quarter results from the biggest names in the sector. The Mag 7 shedding roughly $755 billion in market cap in a single session. Joining us now, Doug Clinton, Deepwater Asset Management Managing Partner, big tech investor, or big expert in this field. So it's good to see you in person here. Thanks for coming in.
Thank you.
So I want to pick up on what Dan Halley was just talking about, which I think is a bigger conversation right now that has been coming more and more to the fore, which is, where are we in AI, and in terms of timeline, and both just sort of realization of what we're going to see monetization-wise from all these products?
There's this adage in tech that new innovation often ends up being bigger than we expect, but it takes longer than we expect. And I think to Dan's point, we're in this acute phase right now where the big cap tech stocks, they've been investing in AI now for a year plus. They've spent a lot of money on CapEx, but they haven't shown results yet. And you tend to see this in all these emerging tech cycles. I think that we still are going to sit in this kind of gap between investment mode and then harvesting mode for maybe another year. I don't think we're going to see a ton of revenue coming from these new AI products for maybe a year plus, but I think all of these companies are so committed to AI, they have to get it right. You made that point earlier. They have to get this right because of the magnitude of the opportunity. So I think they'll continue to invest, even though we might not see the top line results from it for a year.
What about, Doug, so obviously, Alphabet and Tesla report, they disappointed. What do you see for the rest of this tech earnings season? Any big trends, themes you'd be now looking out for?
I think it'll probably be choppy, just given how Google in particular ended up. I thought the quarter was generally fine. They said everything we kind of expected them to say. They reiterated the CapEx spend plans that they had. I think that's going to be a big theme as we hear from the other kind of big four next week. So that's the one thing we're looking for. I think that's good for the infrastructure companies in this AI
Who
segment.
would those be, Doug?
Companies like Broadcom, which is a portfolio company of ours, companies like Arista, right? They provide networking equipment for these data centers. I think that companies, these mega cap tech companies, as they continue to build out the infrastructure they need, it's good for these players, and they're not going to slow down even though the revenue is not there yet.
Speaking of this sort of differentiation within the AI trade, we just rolled out our volume 3 of our Yahoo Finance chart book. And one of the charts came to us from David Costin over at Goldman Sachs, and he looked at the infrastructure play within AI versus some of the other types of AI plays, enabled revenues and productivity. Here's the chart here, and infrastructure is the one that's really taken off. He says the performance of those other groups do signal that there is still some skepticism about longer term AI adoption. So with that setup and with the infrastructure companies that you mentioned reporting versus some of the others, what's the reaction going? I mean, I know what your fundamental case is, but I'm just curious how the market perceives it.
I think it actually speaks to the gap that we were talking about earlier. I mean, the infrastructure companies are the ones that are seeing the revenues inflect because the products are being sold and there's huge demand, I think quenchable demand in some cases, given how much this CapEx has grown from the Mag 6. I think on the other end, the companies that have not yet performed, and we haven't seen that inflection yet, like the hardware companies, I think it's because we just haven't seen the revenue inflection yet. So investors are saying, hey, this sounds great. We get it. AI is this big thing. But show us what it means. Show us some revenue and how we should reevaluate our models in the future to re-underwrite these companies at a different level.
What about, Doug, I got to get your take on this story. Tesla may be investing $5 billion in XAI, right, as suggested by Elon in that poll on X. You all are invested in XAI. How as an investor, you think about that? Would that be good for XAI and Tesla, Doug?
I think it makes some sense. And one of the things I think is really cool about XAI and just Elon's orbit of companies in general is that there are these interesting synergies. I think what sets XAI apart as a large language model competitor is their ability to think about the physical world from all the things that Elon does at SpaceX, at Tesla. So I think there's synergies there that could be interesting. If you kind of do some of the math on that $5 billion investment though, Tesla has about $30 billion right now on the balance sheet. Their market cap was, let's say, $700 billion. It's getting knocked around a little today. But even if their investment in XAI from an equity standpoint, let's say 8x, 10x, and XAI was a $250 billion company, it really doesn't move the needle that much for Tesla as a stock. So I think it makes sense from a synergistic standpoint, but you could almost make an argument that Tesla should go even bigger if they think that they can get some value by investing in XAI. Make a real bet that might really impact the value of Tesla as well.
Now, while we're on Tesla, are you guys in Tesla as well?
We don't currently own Tesla. We do own Google, and we're sticking with it even though it's been volatile today.
And you wouldn't be tempted to step in on Tesla as you see this kind of decline?
We've been watching, and we're really acutely, I think, attuned to what they talk about at this robotaxi event in November. I mean, I think that's really probably what the stock is going to focus on as we get past earnings here. And the question again goes back to the model, right? What is Elon going to show us in robotaxi where we should think about a new business model and how that flows through to the bottom line? Can this be a really high margin business that no one's really modeling for Tesla right now? Or is it just they're going to sell some more cars, they're going to license this software, and it's less meaningful? I think that's the outstanding question.
And Doug, you mentioned you all are in Google. Any concerns about the CapEx spending going on there?
No concerns. It's what we think they should do, and it's what we think the rest of the Mag 6 are going to continue to do too. The way we've framed it is they almost can't afford not to spend, because if they miss AI, if these companies, if someone says, hey, we don't think this is the moment, and they stop investing, everyone else continues, and they get it right, that AI is real, that's purgatory for these companies, because anybody who misses it, they'll never catch up.
Not good for Sundar and Ruth.
No, they'll never catch up.
Doug, good to see you. Thanks a lot for coming to the studio. Well, let's get to some of the other trending tickers here on Yahoo Finance today. I want to check on shares of Roku, and this is actually an Alphabet adjacent story, if you will. We talked about how Google's YouTube business was really the sole area where the number, in this case the ads revenue, missed estimates, and now we're seeing a lot of traders extrapolate out what that means for other companies here. Analysts not necessarily expressing a lot of concern, but we're seeing people selling.
Yeah, you saw analysts at Piper covering the name, Julie. They said, weaker than expected YouTube trends. I think they said somewhat concerning for the space. They did mention Roku is coming up on some tough comps. Remember, Roku reports earnings next week, August 1st, so get some more color and commentary at that point.
Yes, we'll find out if people were right to sell.
All right. Coming up, shares of Manhattan Associates soaring today after a surprise beat in the second quarter. We're going to speak to the software company's CEO on the other side. More market domination still to come.
Well, on an otherwise weak day for Wall Street, Manhattan Associates is a standout to the upside. The company reporting second quarter earnings and beating estimates on that quarter. Here to break down the report and talk about the supply chain landscape is Manhattan Associates CEO Eddie Capel. Good to see you, Eddie. Thanks for being here.
My pleasure, Julie. Good to see you.
So let's talk about the quarter a little bit and sort of what was driving what you guys did. Now, you do supply chain, you do cloud services, you do other types of software-related services. Where was the demand coming from in the quarter?
Yeah, really across the board. So, we have 18 offices around the world, a pretty broad portfolio of supply chain management software, everything from execution software, retail store systems, planning and inventory optimization software. And we had a really nice balanced quarter across the geographies, across the product suite, and across verticals. And I think, that frankly is one of the things that enabled us to deliver such a good quarter was that balance and that diversification.
Eddie, I want to get your take on a bigger trend we've been discussing today on the show. As you saw, Eddie, Alphabet reported and disappointed, and Tesla reported and disappointed. And there's some strategists, Eddie, who are kind of bringing up the AI theme today and just wondering whether investors are rethinking that theme, and maybe investors are looking at all that AI spend, Eddie, and they've decided, let's hold the brakes here. Maybe it's more of an expense than a revenue generator. I'm just interested, as a CEO yourself, Eddie, how do you think about the mega trend of AI? How are you all integrating that technology into your own business?
Yeah, well, we're bullish on AI for sure, both from an internal and an external perspective. So our own internal usage of AI, we're beginning to experiment and really adopt that technology. But this month we've launched our first production-ready AI capabilities within our applications. The first release is specifically focused around customer centricity, intelligent chatbots, experiential capabilities for call center associates and so forth, really focused on being able to provide the consumer with a great experience with our retail customers, helping with call deflection, answering real world questions, not those chatbots that get you to the point where you ask the real important question and then they fall over. So we're excited about the opportunities for sure, and we've built a set of products and a framework that allows for really in-depth generative AI capabilities to be adopted. But we are taking a pragmatic approach to releasing capabilities that we think our customers will really be able to use, and frankly, will be able to monetize.
Well, and I want to pick up on that monetization piece, Eddie, because I don't know if you've been hearing the discussions we've been having on the show here, but when you look at a name like Alphabet today, some of the disappointment seems to be that all of these AI investments aren't yet bearing fruit, and what's more, it's not clear when they will. So do you think that expectations have gotten us ahead of themselves? And for you in particular, when will we start to see that monetization?
Yeah, so we've really, I think they are ahead of themselves, but there's no question about that. The promise is there for sure, and I think it is inevitable that all of us will look back, in the not too distant future and say, how did we live without generative AI? Much like we can't live without the internet today. But in terms of our specific monetization, as I said, we launched our first saleable generative AI capabilities this month, and we expect this year certainly to be able to see revenues flowing through from those capabilities.
Finally, I want to ask you a bigger question about the supply chain and the sort of inventory cycle and where we are now. We just did our Yahoo Finance chart book, and one of the charts we got from Bank of America had to do with the days per sales of inventory, and that there was sort of a destocking cycle that now is normalizing again, all the way on the right side of this chart. I guess I wanted to ask you, post-pandemic, with the whipsawing that we've seen in supply chains and inventory, where we are now on that normalization process.
Yeah, I think we are normalizing. There's no question about that. I think the bullwhip effect and so forth is smoothed out, and we are normalizing. The challenge, though, for every retailer, every wholesaler, every manufacturer is how much inventory do I stock to meet the insatiable appetite of the consumer for faster deliveries, and faster deliveries. You've got to have obviously inventory at the right place at the right time to be able to satisfy that, that need. Look, over the last, let's call it 15 years, we've gone from placing an order and expecting that package to show up on our doorstep, call it a week later. Today, we're in a world, hey, we can place an order at 8 p.m. and it's on our doorstep before we wake up in the morning. Now, you've got to solve that inventory problem. Inventory has to be at the right place at the right time. So our view is that the solve for that problem is sophisticated software that understands where that demand is and can balance the location of the inventory being in the right place at the right time to solve for that demand. But I think the big picture of inventory normalization and inventory levels, has settled down for sure.
Eddie, so good to have you on the show today. Thanks for joining us.
Thank you, Josh. Really appreciate it. Thank you, Julie. Bye-bye.
Another trending ticker we're keeping an eye on here, Enphase Energy. Shares are jumping despite missing on Q2 earnings. The solar company revealing it was able to sell off overstocked inventory from the slump in solar demand last year, up 13% here, Julie. So solar equipment maker, sounds like business in California was really in focus here. Sales to system installers there rose by more than 7% versus the first quarter, 14% jump in batteries. Execs saying our California business has stabilized. It's always a word investors appreciate hearing.
Yeah, and what that had to do with was the ripple effect and aftermath of new regulations in California that were encouraging homeowners who had solar systems to also have storage, some kind of battery system put in. So that kind of created some hiccups in the system. We've also seen a lot of pressure on the solar industry. Pressure from higher rates. Yep. We've seen a slump in many of these stocks this year. We just heard news recently about potential, SunPower has been struggling, so that's been affecting the industry. So it seems like the fact that these numbers weren't worse and that they did use that language, that seems to be a relief for investors.
Yeah, and Enphase enjoying a nice pop today, though still worth noting. It is well in the red still this year.
Yes, indeed. And let's talk some frozen potatoes, shall we? Lamb Weston stock falling as a result of missing
Look at
earnings.
That move. That you don't see often.
Yeah, CEO Tom Werner saying demand for frozen potatoes fell during the previous year, and 2025 will be another difficult year here. Werner talked about the operating environment changing rapidly over the past 12 months. Global restaurant traffic, frozen potato demand softening because of menu price inflation. And so that was an issue. And this is so interesting to me. Like, what do I know from potatoes? Potatoes are not an expensive food.
Right.
And so it's interesting to hear that this is having such an effect on this company's business here.
Just getting wrecked today. I mean, I saw some analysts saying, listen, Q4 results were disappointing. Investors, they noted, were braced for conservative guidance, and that the company's newly established adjusted EBITDA guidance, they say, will come as a shock, and that sure did come as a shock. And look at that, we're only down 30% in today's trade. And you do wonder what that tells us more broadly about the restaurant sector. Julia, what does this mean in terms of traffic and demand?
I think these guys supply fries to McDonald's, so you're seeing a little bit of a ripple effect, and people try and figure out what that means. Stay tuned. We're going from potatoes to luxury handbags. We're going to break down the luxury consumer industry on the other side.
Let's get to our call of the day now. Piper Sandler downgrading Ulta to neutral from overweight, saying the company's increasingly using traffic drivers, but it's not enough to outweigh margin dilution concerns. Shares sliding more than 5%, its lowest level since August 2022. So Piper Sandler, Julie, no longer is confident here. They do go to neutral, target 404. They talk about increasing competition, Sephora adding storefronts to Kohl's, Amazon building a position in beauty. They talk about promotional activity that Ulta, they say, has been more promotional in recent months. So move to the sidelines here, lukewarm.
Yeah, I love the language sometimes that folks use in these notes. Pulling on traffic drivers, as you said, is what she wrote. Sales, there's more sales. And when you put things on sale to get people in the door, when you have those promotions that you mentioned, your margins get smaller in many cases. And so that's what she's concerned about, the several sources of margin dilution here. Ulta, remember, came out and kind of shocked the makeup and beauty industry earlier this year with a warning on its numbers. The shares are down 25% year to date.
They had a 52-week low today.
Yeah, so we've already seen this slump here. So it's interesting that she's getting more negative, even with that context and that backdrop. Well, let's broaden out and talk not just about beauty, but luxury. LVMH led a sell-off in global luxury names today after reporting lower than expected sales as shoppers continue to pare back big purchases. With more on the state of the luxury consumer, we're joined by Pauline Brown, LVMH former chairman of North America. Pauline, it's always good to see you. It seems as though the problems, some of the issues last quarter, not just at LVMH, but also at Kering and at Gucci within Kering, have something to do, not necessarily with Western consumers, but with consumers in China. So how big of a headwind is this for the luxury companies?
Oh, it's a massive headwind. Chinese consumers have accounted for the lion's share of the growth, not just in the last few years, really in the last 2 decades. And that's in part because it's been such a fast-growing market, in part because it now produces more billionaires than anywhere other than the U.S., and in part because Chinese in general have a great appetite for luxury goods. So when the Chinese sneeze, I guess the rest of the world has a bad cold, and that's what we're seeing now.
And Pauline, I had read that one big trend with Chinese shoppers is they often go abroad. When they're looking to buy luxury goods, they'll go to Japan, for example, to take advantage of the weekend. Is that a trend, a theme we see playing out?
It is, but they're not shopping in quite the same way they were just a few years ago. 10 years ago, about 90% of Chinese consumption of luxury goods happened actually in the West, primarily in pockets of Europe, and then to a lesser extent in the U.S. More recently, that shifted to the region. So Chinese are traveling quite a bit this year to Japan, where the exchange rate is favorable to them, and also to Seoul, which has also been a big feeder of trends for the region. That said, there's a lot more options for them to buy at home in Shanghai, in Beijing, even in second and third tier cities than there were just a few years ago. And so when they do travel, unless it's very good value, they're less tempted to buy than they were in years past.
Pauline, I do want to broaden it out beyond China because I'm curious what we're seeing among luxury consumers in other regions of the globe. Are we seeing them, on the lower end, we've talked a lot about consumers being sort of more choiceful, not making necessarily all of the same decisions they were making a year ago. What are we seeing on the high end?
So let's divide the high end into what I'll call the ultra wealthy consumer, that top 2% that are doing okay vis-a-vis the stock market and the housing market. Their lifestyle doesn't really change, even when those particular indices do. And then you have the aspirational consumer, the upper middle class. That's a more sensitive audience for luxury brands. It has, here in North America, constituted most of the growth over the last many years. And it also, I would say, has been the quickest to slow down. I think what we're seeing right now, though, is not just a slowdown in both of those two segments, but also a bit of a reaction to the price inflation Even ultra rich people don't want to spend that much more than they were a few years ago for the same products. And what we're seeing with a lot of these luxury brands is they've really taken price up as far as I think is reasonable, maybe too far.
So, Pauline, it does sound like a challenging backdrop here in a couple different ways. When you look across the sector, across the space, are there certain names that you think are better positioned than others to navigate it?
Well, as is always the case, those that have depth and strength are going to weather this market better. So we're seeing those that have pivoted, have already, even in very robust times, been struggling to keep up, like a Burberry or a Coach. I think they're going to be hard hit. LVMH has historically done better, not simply because it has a staple of great brands that do withhold or hold their value, but also because it's a very well hedged portfolio. So you have a number of brands within that group, like a Sephora, that are not as dependent on the luxury consumer as, for example, a Christian Dior or a Dom Perignon. That hedge, though, has probably been taken as far as it can, which is why even here in the US, which was a relatively stable market next to Asia, we still had nearly flat growth to year ago first half.
Pauline, thank you so much as always for joining the show. Appreciate it.
Good to see you.
And we are minutes away here from the market close and stocks trading near session lows. We're seeing weakness really across the board, dragged down by big tech as investors digest disappointing results from Tesla and Alphabet. Tech-heavy Nasdaq off more than 3%, its worst day since October of 2022. Joining us now is Yahoo Finance's very own Josh Schaefer. Joshua.
Yeah, Josh, I mean, the big takeaway today is just that tech sell-off, right? And I think it's sort of understanding that this has a lot more to do with perhaps maybe where we were from a sentiment perspective and how far the market had run up than it does specifically Alphabet and Tesla earnings. Yes, maybe that was our catalyst today, but I think you're seeing the market was probably ready to unwind a little bit. I know you guys talk to strategists every day. A lot of strategists have been saying that for a while now, right? We're kind of at a point where maybe things are a little bit frothy. BMO Capital Markets, Brian Belsky was on yesterday on our morning show, The Morning Brief. He said that. I would argue Brian's usually rather bullish. So to hear him say maybe it's time for a pullback sort of caught my ear. And he actually highlighted a chart in our Yahoo Finance chart book that was rather interesting, talking about pullbacks and sort of the average pullback we normally see in the second year of a bull market, which is where we are right now. We normally pull back about 9%. And at this point to this year, the max drawdown had only been 5%. So people have sort of been waiting for something bigger to maybe happen. And I guess you can look at this chart and see two things. A, this is kind of normal for the market to pull back. Also, B, maybe it's going to keep pulling back and this isn't just a today thing, and maybe it pulls back even more. And I think that's sort of my broad takeaway, just looking at the market action today and sort of how I've been thinking about it thus far.
Yeah, and I've also seen some talk about technical indicators, right? That we were at the 200-day moving average for the S&P, and once you breach certain technical indicators, then that sort of begets more selling. Now, we had, of course, the Tesla and Alphabet induced selling, but we also noticed that chips in particular were really seeing a lot of pain. I noticed Qualcomm on our trending ticker list early in the day, NVIDIA selling off. So what are you hearing on that front?
Yeah, NVIDIA down more than 5%, right? You see Broadcom down about 6% the last time I looked, ARM's down about 6%. And I think I think there's kind of a couple spins you could go with there. Perhaps one is if we're questioning how Alphabet is going to monetize all of this AI spending, and that's maybe one of the broader questions leaving that earnings call, right? Eventually, do they stop buying some of the chips that or do they create their own chips, right? I think that's still a question that's out there, is are these big hyperscalers going to get into creating some of this own technology for themselves, since they are investing so much into it? But the other thing, Julie, that I think will be interesting just to watch over the next couple of weeks with NVIDIA is we keep talking about big tech earnings. We're still a month away from actually hearing from NVIDIA. And so to see them and the semis move on other news and tech and sort of just react to what else is happening. We know NVIDIA's earnings have come in very strong and told a little bit of a different story sometimes than how it moves going into earnings. We kind of saw the same thing last summer. NVIDIA tailed off a little bit into earnings and didn't have that great of a summer and then eventually bounced back. So I don't know. It's a fun one to watch because it does move so much, but just simply put, with chips down as much as they are and the Mag 7 having their worst day on record by market cap loss, that's just going to weigh.
And some
on
of
the
these names, though,
average.
too, Josh, we'll show like an NVIDIA chart, but they've had such tremendous runs. I mean, they're remarkable, right? Some of those chip names that we talk about. I also thought it was just to bring it back to chips, too. Another theme I want to get your take on was just, and we've been talking to CEOs and strategists today about this, is just the AI theme and trade, and whether after the print and the Tesla print, is there just some renewed skepticism about that from investors?
I think maybe renewed skepticism, Josh, too, and just right now, when you've been talking about this market rotation for the last 2 weeks, there aren't a lot of people who are looking to outperform the market over the next 6 months going into the end of the year that are saying, I want to buy NVIDIA that's up 120% this year, right? If you're looking to outperform over the next 6 months, right, which is what a lot of pros are trying to do, I don't think that's the name you're going to go fishing in, right? And maybe not even some of the other tech names. It's what's working in other areas of the market is where you might have a chance to actually outperform the index. And I think that gets to your point of just these things have run up a lot. It's going to take a lot more solid evidence, I think, to keep people coming back in. Now, if we see more of a drawdown, the question is at what point do people start calling buying opportunity? I didn't see that opinion out there that much today after one sell-off. But
yeah, and then this sort of relates back to your first point about the average drawdowns. The VIX has finally been perking up a little bit, reflecting this volatility that we've been seeing overall in the market.
Yeah, so we've had a quiet VIX for most of the year, right? And that's kind of been the underpinning of our chug higher. That's a typical feature of a bull market, is a quiet VIX. You look today, the VIX is up significantly. We're approaching 18 right now. And I thought it was interesting, Josh, we talked about this in our market takeaways earlier this week. DataTrack had highlighted on Monday, they said they don't think people are going to move back in to large cap tech until the VIX hits at least 19, which was the high we saw in April, if not maybe 21. So just as the VIX ticks up, you normally need to see it start coming back down a little bit for people to feel comfortable with the level of volatility we're seeing in the market. And based on today's action, it seems like it's going to be something that's here to stay, at least in the short term.
All right, Joshua, thank you, my friend. Appreciate it. All right, while we're wrapping up today's market domination, don't go anywhere because another slew of earnings reports are set to drop after the bell, and we've got you covered with all the action. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's market domination overtime as we await the slew of earnings reports in just a few moments. Let's catch up to speed on what happened in today's session. Maybe we call it market decimation instead of domination today, because we saw this sharp sell-off happening in the major averages. The Dow down more than 500 points, about 1.25%. The S&P 500 down by more than 2%, and the Nasdaq, the big loser on the day, down 3.6%. And as we talked about within the Nasdaq, the Magnificent Seven seeing the biggest market cap, market value decline since Meta went public. Also seeing the Nasdaq Composite itself down the most since late 2022. All of this, of course, as we've been talking about, really having to do with the earnings that we got from Alphabet and from Tesla. So I wanted to get on check on how they closed here today. Alphabet down by 5% on the session, even though by most accounts, the numbers are pretty good, but there seemed to be a little bit of disappointment with a couple of areas. One, the YouTube ads business slightly missing estimates, and really investors seem to want to hear more about how AI was going to make the company money. So those shares down 5%, but of course, they're up a lot still this year. And then Tesla down 12% after disappointing on earnings. Automotive gross margins, especially excluding regulatory credits, also really missing estimates. But it wasn't just those two stocks. Really, you see all of the Magnificent Seven down steeply. NVIDIA in particular down 6.8%. So we really saw a bleeding over of the selling into other areas. And then just quickly, if you look at sectors as well, the XLK, not surprisingly, and consumer discretionary, the worst performing groups. Josh?
All right, Julie, for more on a rough day for the markets, we're joined now by Sebastian Page, T. Rowe Price, Global Head of Multi-Asset and Chief Investment Officer and author of Beyond Diversification, What Every Investor Needs to Know About Asset Allocation. Sebastian, good to see you.
Likewise. Thanks.
So you say, Sebastian, you are aggressively, confidently, with lots of conviction on the stock market, neutral. Why this strong neutrality? Why aggressively lukewarm, Sebastian?
I have to say that we've never had this intensity of debates in our asset allocation committee between the bulls and the bears. And trying to boil it down into simple talking points, what are the bears talking about? A declining economy and high stock market valuations. That's pretty compelling. What are the bulls talking about? Hey, earnings are actually coming up overall, and rates are coming down. So those are the key issues confronting the bulls and the bears. And you end up in a place where it makes sense in this market environment. And this is why I like to use the word confidently, aggressively, whatever adjective you want for neutral. Invest in line with your long-term risk tolerance. This is an environment where you do a lot of work, say if you're an individual with an advisor. How much risk do I want to take over time? I think this is kind of the sweet spot where you want to be right now. And today's a rough day in markets.
Yeah, so in other words, to focus on the long term instead of the short term is kind of where you come out. But why at this moment more than other moments? You know, because usually the bears and the bulls each have fairly compelling arguments, right?
That's very true. You have moments in markets where, for example, there's a bit of panic and the VIX goes way up 20, 25, 30. This is usually, not always, when we actually want to buy in overweight stocks. So we tend to be contrarians. And there are moments in markets where everything really looks expensive and like a bubble. I do not think this is like the tech bubble for technology. So you're not in either of these environments. You're in an environment where good arguments from the bears, declining economy, and you know what, high valuations. Good arguments from the bulls, earnings coming up, rates coming down. And so just stay invested, stay diversified. Very trite kind of advice. But I think this is where we are. And by the way, under the hood, we've been positioned for a rotation. So while we've equalized stocks versus bonds, we have been positioned long value stocks. So
why value,
positioned for
Sebastian?
the rotation. You know, there are several ways to play the rotation. You could say, I just want to go small caps. We're actually neutral between small caps and large caps. I think it's more interesting to play it with value stocks because small caps have to struggle with this conundrum, if you will, that they really will perform well if rates come down. But if rates come down, it's probably because the economy is weakening more than expected. And if the economy is doing well, then it's probably with rates being higher or even rising. So small caps are kind of squeezed here in this kind of market. I think the value versus growth rotation trade is more interesting because we look at the macro catalysts on the horizon. I think the election is one of them, is one of the catalysts that could continue this rotation. I said last time, this is not a pound the table call. It's a moderate overweight value. We still like a lot of those growth stocks, even today, you know, when they draw down. And so it tilt towards value.
Gotcha. So you are a multi-asset strategist.
Yes.
So we've been talking about stocks. Let's talk about the other stuff. In particular, I'm thinking about fixed income. I'm thinking about commodities. Where are you sort of positioned broadly?
In fixed income, we still have a small overweight cash. So we are somewhat short duration. I think we could see the yield curve steepen from here as the Fed starts cutting, most likely, and as the expectations for long-term inflation actually kind of maybe reset to a higher level. You know, we have reshoring, we have potentially inflationary policies coming out of the election. We have all these pressures, so we see the yield curve probably steepening. This is the longest yield curve inversion we've had in history.
Especially without a recession.
Absolutely. Historically, it has preceded recessions. It's been a false signal this time. It's been quite interesting.
Sebastian, we talked about so many variables here: economy, earnings, valuation. What about politics? When the committee meets, bulls, bears, and they debate the election, what do they say then?
Oh boy, that's a long question to answer, but I'll give you the big picture, is that it could be a macro catalyst for potentially a resurgence of inflation, so that is a problem. And the other thing we talk about, you know, we don't debate politics per se, we focus on what is the impact on financial markets and the economy. And when we look at this, one topic we discussed last week at length is the level of US government debt, which is becoming worrisome, especially if you take a long-term perspective.
Sebastian, we got to leave it there. Thank you so much for coming in.
Thank you so much.
Appreciate it. And we've got some of those promised earnings coming out. Let us start with Ford. The share's taking a quick leg down of 7%, and that's on what looks like a big miss on the bottom line. 47 cents a share is what Ford reported in earnings. That is 20 cents light of the average analyst estimate. The company is keeping its full-year EBIT forecast, its profitability forecast, unchanged here, interestingly. But if you look at the revenue breakdown from its different divisions, the Ford Blue, which is its traditional gasoline-powered vehicles, $26.7 billion in revenue. That's ahead of estimates. Ford Model E, its EV business, missing estimates at $1.1 billion versus the $1.3 billion that was estimated. And we've been talking a lot about the Ford Pro business, which was expected to be strong. It was $17 billion in revenue, 16.5 around is what analysts had been anticipating. But it's really profitability that appears to be the problem here. I'm just looking at the different business lines here. It looks like Ford Blue in particular was a miss in terms of profitability. The company does say profitability was affected by an increase in warranty reserves, though efforts to lift the quality of new products are starting to pay off with positive implications for customer satisfaction and Ford's operating performance. So as far as I can tell here, it is that warranty issue that seems to have hit profitability, but I'm going to keep digging in here. What stands out to you at first blush?
I'm just looking at comments by President and CEO Jim Farley as well. Talks about Ford Plus is on track. Our underlying quality is improving. He also mentions J.D. Power last month reporting that Ford jumped 14 spots to number 9 in the company's 2024 initial quality study. Farley saying our own evaluations are showing similar quality gains. That was CFO John Lawler saying there. Does note with decline the number of incidents during the critical first 3 months in service. So I'm just looking through the results as well. They also talk in here, Julia, I'm interested in what's going on with the EV unit as well. Executives saying over time we're going to build benefits from Ford Blue and Ford Model E customers, further distinguish us from other automakers, traditional and new ones. Obviously, we know there's a ton of competition in this space. All right, still to come, we're going to take a deeper dive into the latest earnings from Ford. Plus, we're still waiting for the numbers from IBM and Chipotle as well. All that and more when Market Domination Overtime returns.
Chipotle reporting second quarter earnings. The shares up almost 9% in reaction here. The company said second quarter comp sales rose by 11.1% ahead of the 9.2% estimated. Second quarter earnings per share 33 cents and revenue coming in at $3 billion. That earnings per share number, actually adjusted earnings per share, let me say, are 34 cents, 2 cents ahead of estimates. And the company says for the full year, it's still planning to open 285 to 315 new restaurants here. So Chipotle's sort of chugging along here with its numbers. It looks like margins also ahead of estimates at 19.7% overall and restaurant level at 28.9% here. So continuing the sort of steady demand that we've seen
What's
for Chipotle.
impressive about this is how, and we talk about this all the time, Julie, I mean, broadly, a relatively challenging restaurant backdrop, a consumer, or at least some consumers who are tightening their wallets. You got the fast food chains, very promotional. Against all that, Chipotle is, still reporting and pleasing investors.
Steady as she goes. Now, there was a little bit of noise in the quarter. During the quarter, there was a whole sort of social media complaint chain about portion sizes.
There were analysts going out and doing their checks.
Yes, and there was this whole theory that if you went to a Chipotle with a camera, like you were posting, that you would get a healthy portion.
I have to tell you, if I was late to the Chipotle story, as you know.
Oh, I know.
But now that I'm into it, I don't know how much bigger you want a burrito. It's the size of my forearm.
They are large. They are definitely meant. You can easily divide it into.
You can feed the entire Lipton family on that burrito. Is
Yes,
what I'm
you
saying.
could.
It's a small family. Granted.
And by the way, we should mention tomorrow morning, Chipotle CFO Jack Hartung, who recently announced his retirement from Chipotle, but friend of Yahoo Finance, Jack Hartung, is going to join our Brian Sozzi in the 9 o'clock hour. So always
Looking
look forward to
it.
hearing from
Big
Jack.
interview. All right, let's get to IBM shares. Let's get those results right now. We got beats across the board here. Operating EPS 243, beat, Julie. The Street was at 220. Revenue, 15.77 billion. That's a beat. The Street was at 15.61. I'm just looking quickly through some of the segments here. Software revenue, 6.74 billion, beat. Consulting, a bit light, 5.18. Street was closer to 5.3. But we have Brian Sozzi right here.
You sold me on Chipotle, dude. I'm getting 3 bowls tonight, baby. Double meat.
I'm hungry just thinking about it.
I'm psyched.
You just talked to Big Blue CFO. What do they have to say, Brian Sozzi?
Look, I'm surprised initially by the market reaction. I thought the street would have looked into that data and AI business under the software business for IBM. That part of the business was down 3%. I asked Jim Kavanaugh about that. Not seeing any weakness on AI. There has been a theme after those Salesforce earnings, and ServiceNow caught a really bad downgrade to sell 2 weeks ago. Some fears that companies are not upgrading to various AI technologies or tools as fast as the market has priced into these stocks. I asked Jim about that. He said he's not seeing that. Took a very, very bullish tone on AI, a little more bullish than I thought I was going to hear from him. I also asked him his views if we're going to see a pause in customer demand, consulting, software, you name it, ahead of the election. I was going back to some of my coverage from prior elections. A lot of CEOs told me when they came out on earnings days ahead of prior elections, consumers would pause. They would get a little cautious ahead of the election season. Jim Kavanaugh not seeing it. So I guess if you tie all this in a bow, Jim's comments, some of the results here, notably that AI result and the strong AI backlog, I think that's why you're seeing the stock trade up higher after hours.
Yeah, I agree with you guys that it's interesting that this consulting drop of about 1% it's surprising that the street is not paying more attention to that. I mean, maybe this is an example where they're looking through to that AI. I mean, IBM also, we should point out, we've been talking about the Magnificent Seven and the big increases that the stocks have had this year. IBM's up this year. It's up a respectable 12, 13%, but we're not seeing a huge surge in the shares like we have.
Slow-moving vessel. That's how you'll see analysts put it.
And a large one,
yeah,
right?
It's a battleship.
So maybe that's part of the story here, too, is that we have not seen this enormous run-up. I mean, the shares have pulled back a little bit in recent days, but maybe that's part of the story too.
And maybe the market just wasn't expecting that much from this consulting business.
Maybe.
It has been under pressure for IBM the past couple of quarters.
Yeah.
Accenture has been under pressure. So it's not exactly consulting that is blowing it off.
You saw analysts flagging that. I mean, there was
That's
some
correct.
concern.
As long as these AI numbers for IBM came in correct and I think above some estimates, that's a good thing.
Yeah.
Sozzi with the analysis, the insight.
I love Chipotle. I'm so psyched. I'm going to send you my photos tonight.
And you're going to be back with more earnings.
I'm not going anywhere.
He's right here. He's got more news. He's got more news coming.
Come on.
Can't go anywhere. IBM reporting better than expected second quarter results. The stock is rising in after hours trading here. Joining us now is Dan Morgan, Synovus Trust Senior Portfolio Manager. Dan, always good to have you on the show. Let's get right to IBM's report, Dan. They reported investors clearly like what they see, at least initially here. Got the stock popping about 4% in the after hours. What did you make of it, Dan?
Well, Josh, I mean, just beyond the top line revenue beat and earnings beat, I think that software number coming in at 6.7 billion, that's about a 7% year over year increase. The street was looking for about a 3.5% increase. And the number that really stuck in my mind, guys, was when they come out and said that they've got about $2 billion in booked revenue in generative AI. The last quarter and the first quarter, they said they had about $1 billion. So that number is now doubled. And you may have reported, Josh and Julie, on the acquisition that IBM did this cycle. They picked up a company called Hashi, which is a company that's focused on the public and hybrid cloud platform area, but that falls into that software segment. So I'm wondering if that's what kind of helped them boost up the numbers as they kind of closed out this second quarter print. And
I'm curious, Dan, as you look at that Watson strength here, what does, we've been talking about AI with everybody, right? What is IBM's sort of unique offering or unique proposition here when it comes to AI?
What's interesting, Julie, because they haven't really been playing in the same sandbox as much as, let's say, AWS, Azure. We think of them in the infrastructure as a software space. You think of platform as a service. You think of companies like Microsoft, software as a service. You think of Salesforce. They've been more focused on the hybrid space. That's really the area, if you ever sit in on their investor conferences, that they talk about. You mentioned Watson. That's a big AI initiative for them. But they haven't really been playing in the same game that a lot of these other companies have been. So they just have a different strategy towards AI and cloud that I think a lot of these other companies do? I mean, let's face it, most of the action at this point has been in the data center, correct?
Yeah.
Let me ask you, Dan, and just sticking with that theme, because we've been talking about this all show with different CEOs and strategists. I'm really curious, just as a longtime tech investor, to get your take on this AI trend, Dan. Do you think after Alphabet reported and disappointed and Tesla reported and disappointed, there were some strategists, Dan, who looked at that and said, you know what, maybe there's a narrative shift going on here where investors are suddenly deciding, hold on a second, all this AI spend, it's just looking like a big expense, not a revenue generator. How do you see it, Dan? I'm very curious to get your take there.
You're exactly right, Josh. I mean, Alphabet came out last night and, their GCP unit was up the same amount in growth that it was the quarter before. And then I think that the CFO told us that she spent $13 billion in CapEx. So it's a huge number. And now we're going to roll in, as you said, into Microsoft and Apple and Amazon next week. And, collectively, those companies all expected to spend about $180 billion. It doesn't appear, though, Josh and Julie, that IBM is really in that same hyperscale battle in terms of trying to generate ROI off a huge amount of CapEx. So that's why I think this report is being kind of met with a little bit of applause, because, as we mentioned earlier, they came out and said, we've got $2 billion in booked revenue in AI, and they're not spending this massive amount in terms of CapEx. So I think there might be a little bit of switch, Josh, in terms of the narrative, hopefully going into next week, and maybe IBM can get that pivot point.
Dan, I'm just looking at some of your current holdings within tech, and it's a pretty broad group, right? You hold a lot of the large cap tech stocks, and I'm also curious if you are adding, as we have seen this selling pressure, obviously today, but in recent days as well, because when we've talked to you in the past, your conviction's pretty high here on the sector.
Yeah, Julie, I mean, we had a big sell-off a week before last related to that ASML report that came out in terms of the chip space. We saw a lot of companies in that area like Qualcomm and Broadcom and so forth sell off. That did create an opportunity. But we haven't really changed, Josh and Julie, our bullish stance on those big cap names that you see on that listing in terms of our holdings. I mean, as you said, Julie, we've rode a huge wave here in the last 15 years. It's been fantastic. But I don't see a switch in the narrative, quite frankly. I mean, we're looking at the possibility of rates dropping. That was the bigaboo for the CIOs to supposedly cut back when rates were going up in terms of IT spending. So I think everything's still in place for strength, as we go out to close out this year. And I'm optimistic next week we'll get a little better earnings reports.
And Dan, just to, on IBM, obviously a lot of investors are going to look at that as sort of a broader potential tell on broader enterprise IT spend. What do you see in there in terms of themes and trends, Dan? Does what you just saw in IBM, does it give you more confidence about that?
Josh, we look at IBM as really more of a dividend yielding kind of, huge amount of reoccurring revenue generator. They generate about 50% of their revenues that come regardless of what the economy does. They pay a very high dividend. They have about $12 billion in cash flow. So they're a little bit of a different animal, Josh, than let's say some of these other tech companies are going to be reporting here in coming weeks. Again, we look at them more as a defensive technology company, something we'd look to in terms of will do well regardless of what the environment is and pays a very handsome dividend. It's definitely not a stock like an NVIDIA or some of these high flyers that are much more volatile and have much more different characteristics in regards to their growth.
Dan, good to see you. Thanks a lot.
Oh, thank you, Julie.
Well, let's get a check on shares of Whirlpool Corporation. The share's up about 0.25% here, 1.25%, bouncing around, let's call it, after the home appliance manufacturer reported its second quarter results. And Yahoo Finance executive editor Brian Sazzi back with us.
Did it go anywhere?
To talk us through the numbers.
Yeah, I mean, some Chipotle, some IBM, some now housing market. We can do it all here on Yahoo Finance. I'm surprised by this market reaction, more so than I was IBM. Sales down in that key North America market for Whirlpool, down 5.7%. Asia as well, a little bit under pressure. I know you see sales up 19%, 19.7% year over year up, but I think there was some pressure there in that business. But the big call is the company's earnings guidance. Scroll down to the bottom of the earnings release. Adjusted earnings per share now seen at $12 a share. 3 months ago, Whirlpool was looking in a range, I believe, $13 to $15. So they are reaffirming their top end or their revenue outlook, but really cutting their earnings outlook, I would think, in large part because of that pressure in the North American market. All day we've been digesting the latest read on the housing sales. Housing sales have been weak. Home prices have gone up. But if you're not out there selling homes, you're not putting in new appliances from Whirlpool. I don't think this is a Whirlpool problem. They're still putting out high quality items. It's just a function, guys, I think, of the market, the housing market just not being what it needs to be to move the units that Whirlpool needs to move.
And you're going to talk to the CEO in a little bit.
Yeah,
do you have a Whirlpool? Do you have a Whirlpool dishwasher, appliances?
Actually, I don't actually. But I do like Whirlpool appliances. But I hope Mark Bitzer's not in the green room, digital green room yet. Nonetheless, I'm talking to Chairman and CEO of Whirlpool, Mark Bitzer, at 4:45 p.m. Eastern Standard Time. Stick around. Mark is always one of our favorite interviews. Real forward-looking indicator that is Whirlpool. You and I have been talking to this guy for 3-4 years already.
I mean, when we talked to him, he was the leading edge of letting us know what was happening with the supply chain during the pandemic.
And he's no BS. He said, you know what, if these results stink, I mean, they're not good. We're going to do better. That's why I love Mark. He's a good guy.
Great.
Sazi, thank you, my friend.
Yeah,
always love having you.
Appreciate you, man.
We're continuing our earnings coverage. On the other side of the break, we're going to break down the latest earnings reports from Ford, Chipotle, and Whirlpool in asking for a trend that's coming up next. Welcome to Asking for a Trend. Earnings season in full swing, and shares of Chipotle surging here after hours. The company reporting a second quarter earnings beat just moments ago. And for more reaction, we're going to bring in Morningstar analyst Sean Dunlop. Sean, it is good to see you. So let's get right into these earnings, Sean. Chipotle reports investors clearly like what they see here. This stock is up about 12% in the after hours. Sean, what did you make of the report?
Yeah, I think in a sentence, the earnings results that we saw really assuaged market concerns that traffic was going to start to slow at the burrito chain. We've seen a lot of weakness industry-wide, and we've seen a bit of what you could call a value war, particularly with fast food restaurants. So there was some concern that might bleed into Chipotle's results. Obviously, that's not what we saw. So sales of $2.95 billion clocked in pretty well in line with our estimate. Comparable store sales growth of 11%. Was split between 2.4% price mix and then almost 9% growth in comparable transactions. So that's really wild when you juxtapose that with a 2.3% decline for the fast food industry over the past quarter. So really, really solid earnings results.
So Sean, I'll just ask this briefly. How? How do they keep achieving these numbers?
Yeah, it really is sensational. I think they would point to improvements in operations that have been laser focused on increasing their peak transaction capacity, and they measure that as the number of burritos that they can move through a store in a 15-minute stretch. And you've got restaurants basically operating at 100 entrees per hour at this point, and that's still not quite where they were back in 2014, so they see that as a big lever moving forward. I think another piece that's related is Chipotle has been a lot more cautious about taking incremental price increases. It's a little bit higher quality food, bigger portions. And so what we're seeing from consumers is that as fast food players have raised prices pretty aggressively, if you look at restaurant CPI stacked back to 2019, pre-pandemic, it's up 29.5%. That value gap between what you get when you go to a fast food restaurant, when you go to a fast casual like Chipotle, has narrowed substantially. So you've got consumers that maybe are visiting restaurants less often, but they're willing to make that trade up to some of these higher quality foods where maybe you're getting a little bit better perceived value for the money. And that really obviously has favored Chipotle here.
And Sean, we did hear a lot of hot talk about portion sizes at Chipotle. I'm sure you heard that too. There were even some of your colleagues, some financial analysts were going out there and kind of tracking portion sizes at different locations. How are you thinking about that headline, that dynamic?
Yeah, I got a kick out of that particular study. I mean, we've all got our favorite Chipotle. You know which one gives you the best portion sizes. I think the way to look at it from a financial materiality perspective would be to the extent that this is something that's actually happening. It's not like you still get that first consumer visit. So if a consumer visits every 2 or 3 months, you wouldn't really see it until the second or third where they'd stop coming. So that's still a risk, but I would look at that as more of a tail risk. I think for Chipotle, kind of the bigger risk factors now are as you look at that value gap widening again. They're really not leaning into discounting, I don't think. There are other restaurant OpEx line where marketing is stored, collecting at 12.9% of restaurant sales during the quarter. They'd projected 15%. I'm guessing at least some of that is tightening the belt on marketing expenses. If that value gap gets wide enough again, you might see some consumer traffic migrate to cheaper meal occasions at QSRs. But I think the biggest risk for Chipotle is if they're unable to deliver on this 8% to 10% long-term unit growth algorithm. So far, so good. If anything, I think site availability might get a little bit better with some of their peers pulling back on development appetite here in the near term.
Interesting. While we have you, Sean, Jack Hartung, the CFO, recently announced he's going to be stepping down, although he's hanging around for another few quarters. Any sort of material risk with that transition that you expect?
No, I mean, Jack's obviously fantastic, and he's been around for 25 years. I think this is just normal run-of-the-mill retirement, leaving the business in a really healthy place. And I would imagine from a strategic continuity perspective, we wouldn't really see any strategic changes. So nothing of note to call out there.
Sean, great to have you on the show today. Thanks for joining us.
Thanks for having me.
And stay tuned tomorrow morning. Chipotle's outgoing CFO, Jack Hartung, will join Yahoo Finance's Brian Sozzi. It's going to be in the 9 o'clock hour. Shares of Ford sinking here following their latest earnings miss. And joining us now for more on the report is Nishit Madlani, S&P Global Ratings Senior Director and Sector Lead for Autos, Business and Technology Services. Thanks so much for joining us. Let's get your reaction to this report. Investors clearly not happy here in the after hours. Ford down about 12% here. What did you make of the results?
Yeah, first of all, thanks for having me. So I will say yes, there's been lots to digest. One recurring theme from Ford's earnings over the past few quarters has really been around their progress on cost reduction. It's been slow, it's been inconsistent relative to peers. So whether it's warranty, supplier instability, parts-related costs, I mean, this time it looks like warranty. They've taken down their full-year EBIT for the blue segment down. So, I mean, from our standpoint as a credit rater, it just reduces cushion for underperformance. But luckily for them, there were a few positives.
Well, I forgive me, I want to dig into the negatives linger there for a little bit because of the reaction that we are seeing on the equity side and because the magnitude of the miss on earnings. Can you walk us through what exactly these warranty issues are and why this seems to be such a weight for them?
Yeah, and to be honest, through the course of our ratings trajectory for them leading up to the upgrade, we've always been skeptical around their story to turn around product quality and reduce inflationary pressures from suppliers. These things don't happen overnight, and we built in a lot of haircuts in our forecast. we were seeing gradual progress in the past few quarters leading up to this one. But clearly, the management team said there's a lot of room for improvement. From our standpoint, the cost of repair has gone up for the industry due to inflation. But I'm sure there are going to be more questions around, what really is the root cause for rising warranty claims. So I'm sure it's going to be a big topic on their earnings call about 20 minutes from now.
If you had one question on that call, I'll give you two. What would they be?
Well, I think it's just in terms of the root causes. Like I said, the management team has invested a lot in terms of ensuring that product quality is paramount, and therefore that was one of the tenets behind reducing costs. They also had the theory around getting better improvements on costs with lesser product configurations, more simple manufacturing processes. So I think an update on all of those will be very important, because under Jim Farley, to be honest, their strategic direction has been much better. They've been very focused on only segments where they can make money. They've taken some aggressive decisions on exiting certain markets, but it's this cost story where we just haven't seen the traction that we would have expected.
Where do you think is the most room for them to improve? I mean, they did highlight in the release that in Model E, costs were down $400 million. I know there had been a lot of focus on that division in particular. Is there more fat to take out there, but also in the other businesses?
Yeah, look, I'll say the biggest upside for them, comes from their Pro business and reduced losses in their E segment. The Pro segment, their commercial fleets, they've had a stellar position there. It's a solid profit-making franchise, 25% market share, 15% EBIT margin in this quarter. And that does benefit because of upside from software and physical services, which, is one where they make a lot of money from. On the E side, to your question, EV sales are stagnating a bit for the industry. So we're not counting on too much loss reduction within that segment. But I think the upside from Pro and some gradual cost reduction in the rest of their business should help offset these challenges in the E segment and, of course, inflation.
So for Nishit, what you said there was interesting. For EV sales broadly, not just for Ford, but the industry, you don't think we've hit some kind of trough there? You think more downside ahead?
I think it's going to be, when you talk about downside for EVs, it's relative to your growth expectations, right? People were talking about EVs representing 15, 20% of sales. We're not quite there yet. Last year, that number was close to 7.5%, 7% pure battery electric vehicle sales. First half of this year, that number has actually gone down from 7.5 to 6.9. So I think the level of growth is going to be slower than most people expected, but at the same time, volumes are going to be up. It's just that not at the same level at which most people expected.
Nishit, thank you so much for joining the show today. Appreciate the instant analysis and insight.
Thanks for having me.
And coming up, Whirlpool Corporation CEO Mark Bitzer on the company's latest earnings print. We're asking for a trend right on the other side.
Shares of Whirlpool are in focus in the after hours following the company's latest earnings report. Let's get right to Whirlpool Chairman and CEO Marc Bitzer. Marc, good to good to see you as always. Thanks for making time with us here. Let's lock in on that North America business because I think a lot of investors are seeing weakness in existing home sales, weakness in new home sales, but home prices are up. What are you seeing in North America, and how is it impacting that North America segment for you?
Yeah, so Brian, first of all, thanks for having me here. In particular, if we zoom in on the North America business, we actually have been pleased that we had a solid sequential margin improvement from Q1. So we feel good about the improvement. We're not yet at the levels where we want to be, but we in our guidance, we basically all said Q3 and Q4 we will see further improvement. Having said that, and that's to your point, we are still in a negative macro cycle. As you know, the housing, in particular for North America, drives a big part of our business. And, with existing home sales, yesterday 3.89 and housing starts at 1.350, it is still very soft. I mean, again, to put that in perspective, existing home sales, last time you've seen these numbers was pretty much in 2008. So that is still very soft. But I emphasize still, it is, and that's a really important thing, it is not a lack of demand. The demographics are strong. Household formations were reported at 2 million. The demand is there. There's just no supply because people don't want to sell their existing homes because that basically in most cases means giving up a very favorable mortgage rates. So that is still the overhang over the industry. At one point it will go away. What is different from what they had in mind? We originally assumed this would start going away in 24, and I don't think it's going to go away in 24.
Is the reality, Marc, that the housing market just needs that first rate cut from the Fed, and then that spurs more activity, and then 2025, we're having this discussion, it's in a different Whirlpool?
I would agree with that summary. I mean, as we internally talk about, interest rates, they don't change demographic trends or the age of a housing stock. The age of a housing stock is the highest it's been in history. Demographic trends are strong. It's the interest rates, mortgage rates, and this famous lock-in effect, which many consumers experience, which holds everything back. I would, however, be cautious. One interest rate reduction won't unfreeze the market. I think it will take several moves. I would expect that probably you need mortgage rates to see in the 5-something, 5.7, 5.8 rate to really see some momentum building. Now, every little step will make a difference. It's not going to be a big cliff or big jump. But of course, yes, as a company like ours, which is so exposed to housing, we're anxiously waiting for the interest rate reductions.
Marc, I went over to my friend's house a week ago, and of course I knew I was talking to you today, and I left their house, and I'm thinking to myself, wow, this guy's appliances are like 10 years old, and they're kind of crappy. I mean, are you just seeing people hold onto their appliances longer because they're just better made?
First of all, you should send me the address of your friend so we can maybe convince them to replacing it.
They're really bad.
But Brian, there's two almost offsetting elements right now in play, and we talked about this. The replacement side, because people are using the appliances more often, so people are replacing it at a fairly high rate because there is increased usage. The problem for replacing is it's typically doesn't come with a high mix because people are just replacing quickly with short notice, whatever failed to be operable anymore. The soft side is people are right now hesitating to make that big move into a new house. In some cases, they're even hesitating making a complete kitchen remodel, etc., even though that's still a reasonably solid business. So the big discretionary purchase where people plan for an entire, we buy this new home, we tear up a kitchen, that part is right now very soft, and that's what we're experiencing.
Earlier in the day, Marc, I caught up with Ulta CEO, Judy Marks. Of course, they're a very large elevator and escalator company, and they do a global business. And she made a really good point on how a universal tariff or higher tariffs would not be good for a manufacturing company like hers. What are your thoughts on that?
I mean, it's as you know, there's a lot of differing opinions on tariffs and the back and forth, and we got to see how it all unfolds. Us as a company, we're heavily U.S. exposed, just for the nature of our business, and we're by a long shot the biggest manufacturer of appliances in the U.S. So right now, what we look at is just a fair level playing field. To give you one example, with the steel I'm buying, and this is nothing against our U.S. steel producers, twice the price of China steel. If a China producer takes the same steel, puts an appliance, brings to the U.S., they don't pay any tariffs on this today. So all we look is a fair competitive level playing field, because we know we can compete, and we're ready to fight. So how you put it in tariffs or back and forth, as you know, there's many expert opinions on this one. But right now, I just want to be able to fairly compete. We're the last American appliance company of a big size. And, it takes a lot to compete against a very intense global competition, which in many cases benefits from significantly lower raw material cost.
More tariffs, Mark. Would you have to raise appliance prices again?
Well, first of all, if more tariffs, that means our competitors probably would face some issues, whatever they do then with that. But, keep in mind, 81% of what we sell in the US is produced in the US. Unless there's a tariff between Michigan and Illinois, we wouldn't be impacted. So we are a US producer, and as such, and a little bit also Mexico producer, but we're kind of very, very strongly focused in the US. So if tariffs come, it would not dramatically change our cost base.
While we have you, Mark, of course, a couple weeks ago, Reuters reported that Bosch was considering an offer for your company. Now, I've covered Whirlpool as an analyst for 10 years now, as a reporter 7 or 8. That surprised me. Do you have any comment on that?
Yeah, I mean, Brian, unfortunately, I can only tell what we already publicly said is we can't comment, and we won't comment on speculation and rumors. It's been one article which caused a lot of waves. As you also know, we had rumors and speculation before, and we will also have in the future, but we just don't comment on speculation and rumors. I mean, we respect Bosch as a company, and an appliance we've been a competitor for many years, but that's all I can say. So we're not going to speculate on it.
Do you think the market is properly valuing your company? I look at all the work that you have done. I mean, you've taken out millions of dollars of costs in your business. You've restructured the business. What do you think about the company's valuation here?
As a CEO, you would expect me to always say we're undervalued. But I also honestly admit the market is always right. I think what the market might miss is, I think, Brian, and we're doing everything which was in our control, from cost takeout to pricing actions to new product introduction. And I would say even Q2 confirms we're doing that fairly well. We are penalized for still being in this negative macro cycle. I mean, and you can see that, every time there's any news about inflation or potential speculation on interest rates, our stock moves significantly. So I think the market still puts us a little bit in a penalty box from a housing side, but that will change at one point. So the question is, what time horizon does an investor have? And I think the moment you put your side a little bit beyond 24, I think there's a lot of positive to be said about a potential housing cycle. And we are, because of our US exposure and our strength in the housing market and the building side, we're by a long shot the biggest beneficiary of a housing recovery.
Always good to see you, Mark. You're no BS. You always give it to us straight. Mark Bitzer, good to see you. We'll talk to you soon. Good luck this quarter.
Thanks, Brian. Appreciate it.
All right, do stick around. Much more asking for a trend on the other side of the break.
Time now for To Watch Thursday, July 25th. And starting off with earnings, another busy day on the calendar. Both American Airlines and Southwest reporting ahead of the open. And we're also going to hear from AbbVie, Stellantis, and Royal Caribbean, among others. The results from American, Southwest, and Royal Caribbean will provide insight into the health of the consumer and the demand for travel. On the economic front, we're going to get the first look at second quarter GDP. Economists forecasting the U.S. economy grew 2%. This is up from 1.4% in the first quarter. We're also going to get the weekly reading on initial jobless claims in the morning. That number expected to tick down to 238,000 is coming after claims hit their highest level since August last week. And moving over to housing, Freddie Mac's weekly look at mortgage rates out tomorrow afternoon. 30-year fixed now at 6.77%, its lowest level since mid-March. It's coming amid weak data on the housing market. Both existing and new home sales fell in June. And be sure to tune in tomorrow to Morning Brief. Chipotle CFO Jack Hartung will join Yahoo Finance's Brian Sozzi in the 9 a.m. hour. The destocking cycle over the past 2 years has been one of the sharpest ever, but it is starting to moderate. Yahoo Finance's Julie Hyman joins me now with a closer look.
Thanks, Josh. And this was another part of our very rich chart book that just came out a couple of days ago. This chart coming to us courtesy of Oh-Sung Kwon over at Bank of America Securities here. He's an equity strategist. And he looks, this is a percentage of sales days to inventory. In other words, when you see these lines go up, it means there's more inventory sitting around for longer. When it goes down, we have that destocking going on. So basically what you see happen is a spike ahead of some of the recessions that we've had, and then a big destocking. We had that, of course, during the pandemic, where we had first an initial spike in inventory sitting around, then a destocking, and then a restocking, and then that's gone down again and come back up. Now we're once again approaching the average line. In other words, perhaps a little bit of a return to a normal level of the inventory cycle. Now, earlier we talked to Manhattan Associates' Eddie Capel. He knows something about supply chain and inventory because his company provides software and services to companies who are managing their supply chain. Here's what he had to say about where we are in this cycle.
Yeah, I think we are normalizing. There's no question about that. I think the bullwhip effect and so forth is smoothed out, and we are normalizing. You know, the challenge, though, for every retailer, every wholesaler, every manufacturer is how much inventory do I stock to meet the insatiable appetite of the consumer for faster deliveries, and faster deliveries.
And, you know, the bullwhip that he's talking about is kind of this really whipsaw effect that we saw back and forth over the past couple of years. And again, in the eyes of Kwon of Bank of America, this is a bullish sign for stocks.
All right, Julie, thank you. Let's take a look now what's trending after hours here. Bank of America shares edging higher. The bank authorizing a new $25 billion share buyback program, which replaces one that expires on August 1st. It's also raising its dividend to 26 cents a share. Plus, rejected the NBA announcing it will not accept Warner Brothers' Discovery offer for its rights package, instead going with Amazon. In a statement, NBA said the recent proposal did not match Amazon's terms. And take a look at shares of ServiceNow. That stock jumping on an earnings beat and increased revenue guidance. The company also announcing its chief operating officer is resigning amid an investigation into a government contract and hiring of a former U.S. Army technology leader. And it was a big day all around for earnings. We got the latest from Chipotle and IBM. Those shares got a boost, while Ford headed downhill amid a massive profit miss. That is going to do it for Asking for a Trend. We'll see you back here tomorrow at 4:30 Eastern.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.